Hey guys, so in this video, I'm going over 6 of the top ETFs to invest in for 2021. I'm a huge proponent of index fund investing as a fantastic way to generate long-term wealth. There are a couple thousand ETFs in the US and over 6,000 available globally. But these particular ETFs have had a very strong track record in making their investors money. Thanks to Wealthfront for sponsoring this video. Let's get started. My first ETF on the list is the SCHWAB US Large Cap Growth ETF, stock ticker SCHG. This is an ETF that tracks the stocks of the Dow Jones US Large Cap Growth Total Stock Market Index. It includes 235 stocks from companies that are expected to experience higher than average growth, including Apple, Microsoft, Amazon, and Facebook. So right now this ETF is trading for $135.30 with a 52-week low of $94.31 and a 52-week high of $142. We can see that in the last year, this ETF went from the 90s and pretty much linearly went up all the way to where it is right now. SCHG has net assets of $14.59 billion, a dividend yield of 0.46%, year-to-date daily total returns of 3.56%, and an expense ratio of 0.04%, which is very, very low. That means you're barely paying any money to put your money into this fund, which is an amazing thing. If we take a look at the overall portfolio composition, we can see almost everything is in stocks. And as far as these sectors, we are heavy in consumer cyclical, healthcare, communication services, and technology. The average price to earnings ratio is 36.26, and the average price to book ratio is 9.47. Here are some of the top 10 holdings, including Apple, Microsoft, Amazon, and Facebook. And in the last year, like I said before, we have a year-to-date daily total return of 3.56%, a one-year daily total return of 41.71%, and a three-year daily total return of 22.19%. So obviously this fund has performed extremely well. So you can see that 2020 and 2019 were extremely great years. 2018, this fund actually went down. And besides that, we are pretty much always seeing green bars. So SCHG is a powerful ETF because it tracks growth stocks, so it has the opportunity to experience higher returns. SCHG is up 60% in the last year and gained 7.64% in April 2021 alone, which made it the best performing US diversified ETF for the month. Like I showed earlier, SCHG also has a really low expense ratio of 0.04%, which basically means that you'd only need to pay $4 in annual expenses for every $10,000 you invest in this fund. Katie Brockman of Motley Fool analyzed that if you're investing $200 per month into the stock with expected annual returns of 17%, you'd accumulate $1.2 million after 30 years. Now, of course, past performance does not guarantee future performance at all, but it is interesting to view the numbers like that. The next ETF on my list is VGT, which is Vanguard's Information Technology ETF. This ETF contains hundreds of stocks from the US tech sector, with some of its biggest holdings being Apple, Microsoft, and NVIDIA. So right now, VGT is trading at $367.40 with a 52-week low of $250.91 and a 52-week high of $388.73. This ETF has net assets of $50.39 billion, a dividend yield of 0.72%, and year-to-date daily total return of 2.01%. Its expense ratio is a little bit higher than the last one we talked about at 0.1%. You can see that in the last year, this ETF also grew significantly, going from the mid-200s almost straight up to where it is right now. If we take a look at the sector weightings, of course, this is mostly going to be in technology because this is a tech ETF. So 87.93% is in tech, 9.22% is in financial services, and there's negligible amount in the other sectors. The average price to earnings ratio is 33.6, and the average price to book ratio is 9.88. Like I mentioned earlier, some of the top holdings in this ETF are Apple, Microsoft, NVIDIA, Visa, MasterCard, and PayPal. Once again, the year-to-date daily total return is 2.01%, the one-year daily total return is 43.64%, and the three-year daily total return is 27.32%. The annual total return history shows mostly growth, especially for the last 12-13 years. But of course, in 2008, that's when the tech sector got hit heavily, and we saw a decrease of over 40% that year. While VGT only specializes in a very specific sector, making it not as diversified as other ETFs, the silver lining is that this ETF has the potential to experience very high growth rates because it focuses specifically on tech. Since the fund's beginning in 2004, it has earned an average rate of return of 13% per year. So if you'd invested $200 per month into the stock with expected annual returns of 13%, you'd accumulate $700,000 after 30 years. So let's talk about Wealthfront, which is an amazing investment platform and a sponsor I love working with. Wealthfront is a robo-advisor investing platform that uses software to build you a globally diversified portfolio of low-cost ETFs. They even manage it for you so it can be totally hands-off. Here's how it works. The app will guide you through some questions to determine your financial goals and risk tolerance. And then it will design the strategic portfolio of ETFs that's right for you. They're also now allowing you to actually customize your portfolio by changing the weights of the asset classes or even adding new ETFs. You can even build a portfolio from scratch if you want. They have quite a few of the ETFs I mentioned in this video, and we'll be adding more options soon, so it's really a great option if you want freedom with what you're invested in, but also want all the benefits of an automated investing platform. Wealthfront offers many account types such as retirement accounts like a Roth IRA, or traditional taxable accounts just like any other brokerage. This is your personalized financial advisor, except it's way more affordable and perhaps even smarter. And the app is very well designed and intuitive to use. They also help you look for opportunities to lower your tax bill through tax loss harvesting. Right now you can get your first $5,000 managed for free with my link in the description, and after that it's a super low 0.25% annual management fee. Use the link below to check it out. The third ETF we are talking about is the iShares Russell Mid-Cap Growth ETF, stock ticker IWP. IWP is an ETF that contains stocks of hundreds of mid-sized, high-growth US companies. So right now, one share of this ETF is trading at $103.98 with a 52-week low of $73.57 and a 52-week high of $112.69. The fund has net assets of $15.32 billion, a yield of 0.31%, year-to-date daily total return of negative 0.89%, and an expense ratio of 0.24%, which you guys is sort of getting on the high side, but overall still not too bad. In the last year, we can see that this ETF went from around $75 all the way to $100 where it is right now. And if we look at these sector weightings, we can see that some of the biggest sectors for this ETF are consumer cyclical, healthcare, communication services, industrials, and technology. The average price to earnings ratio is 37.36, and the average price to book ratio is 9.7. Some of the top holdings in this ETF are going to be Moderna, KLA Corp, Align Technology, IDEXX Labs, Twilio, Chipotle, and DocuSign. So a mix of companies that you've heard of and some companies you probably have not heard of. Like I mentioned, this one does have a negative year-to-date daily total return of negative 0.89%, but the one-year daily total return is 39.18%, and the three-year daily total return is 17.82%. Most years, this fund has performed in the green, but we did see it negative 4.95% in 2018, a couple break-even years in 2015 and 2011, and of course, a big drop in 2008. But besides that, this fund has performed very, very well. Now, because this ETF focuses on mid-cap growth stocks, there is a greater risk with this fund. But it also means that IWP has the chance to explode in growth. Like I showed you guys earlier, this one has experienced a growth of 9.94% since its inception. But within the past year alone, this ETF has just blown up. Its periods of massive growth, like the one experienced within the past year, sort of make it difficult to gauge a reasonable outlook for IWP's long-term growth. But as I have shown you guys, this ETF has proven for as long as the fund has existed that it can deliver promising results. The next ETF on my list is VUG, which is Vanguard's Growth Index Fund ETF. This is an ETF that contains around 250 growth stocks that are tracked by the CRSP, Center for Research in Security Prices US Large Cap Growth Index. Right now, one share of VUG is trading for $266.41 with a 52-week low of $186.11 and a 52-week high of $278.85. VUG has net assets of $157.88 billion, a yield of 0.61%, year-to-date daily total return of 3.48%, and an expense ratio of 0.04%, which is very, very good. Like most of the other ETFs on this list, you can look at the one-year price chart and see that it has just gone up in the last year, with a couple small corrections. Taking a look at these sector weightings, we can see that a big portion of this fund is in consumer cyclical, financial services, healthcare, communication services, industrials, as well as technology being the biggest. The average price to earnings ratio is 37.78, and the average price to book ratio is 9.79. And some of the biggest holdings in this fund are going to be Apple, Microsoft, Amazon, Facebook, Alphabet, Tesla, Visa, Nvidia, and the Home Depot. This fund has grown almost every single year besides 2018 and 2008. And yeah, you can see that in the last couple years, this fund has performed extremely, extremely well. Like the other ETFs we've talked about, this being a growth ETF, you can expect VG to have high upside potential. I do like that some of its largest holdings include companies like Apple, Microsoft, and Amazon, which are all companies that are relatively stable. And as a result, this should minimize your risk as an investor. Going back to their expense ratio, we covered that was 0.04%, which is very, very good. And it's seen an average annual return of 11% per year. If you take this expected rate of return of 11%, investing $200 per month would leave you with nearly $500,000 after 30 years. Overall, this is a very good and popular ETF that people do invest in. The fifth ETF on my list is QQQ. And the INVESCO QQQ Trust is an ETF that tracks stocks of the NASDAQ 1000. The fund specifically focuses on companies that are at the forefront of transformative long-term trends such as augmented reality, cloud computing, big data, mobile payments, streaming services, electric vehicles, and more. Right now, one share of QQQ is trading for $328.83, with a 52-week low of $223.94 and a 52-week high of $342.80. The fund has net assets of $161.68 billion, an average yield of 0.52%, and an expense ratio of 0.2%. Here's the one-year price chart. You can see that it went from about 220 all the way to where it is right now. And looking at these sector weightings, we can see that a big part of this fund is in consumer cyclical, consumer defense, healthcare, communication services, and technology, which is the largest at 44.06%. The average price to earnings ratio is 35.31, and the average price to book ratio is 8.16. Some of the biggest holdings in this fund are going to be Apple, Microsoft, Amazon, Tesla, as well as many other well-known companies. And the year-to-date daily total return is 2.94%, the one-year daily total return is 43.17%, and the 3-year daily total return is 25.41%. You can see that for most years, this fund performs extremely well, especially 2020 when it saw 48.6% growth. So like I mentioned before, this ETF has an expense ratio of 0.2%, which is not super low, but not super high. And QQQ has seen a total growth of around 9% ever since the fund's inception. And to add on to that, analysts do see an upside potential of nearly 14% for this ETF. If you want to take on even more risk for a greater upside potential, definitely check out the leveraged ETF ProShares Ultra Pro QQQ, whose stock ticker is TQQQ. Whereas QQQ is better designed for long-term investments into large cap growth stocks, TQQQ is more of a short-term, high-risk, high reward investment that relies on taking on debts to amplify the returns of the index that it's tracking. So the last ETF on my list is VBK, which is the Vanguard Small Cap Growth Index Fund. This is an ETF that tracks stocks of the CRSP US Small Cap Growth Index. So basically this fund is tracking the growth of small cap stocks, which means that this ETF is going to be a bit riskier to invest in than ETFs that focus on large cap growth stocks. And you've also probably not heard of many of these companies, but again, the greater the risk, the greater the reward. So one share of VBK is trading for $270.39 with a 52-week low of $184.85 and a 52-week high of $304.93. The ETF has net assets of $37.29 billion, a yield of 0.39%, and an expense ratio of 0.07%, which is also very good. Here's the one-year price chart. You can see that the price started under $200 1 year ago, and since then it's grown to well over $250. If we take a look at these sector weightings, we can see that some of the biggest sectors are consumer cyclical, real estate, healthcare, industrials, and technology. The average price to earnings ratio is going to be 34.72, and the average price to book ratio is 5.22. Some of the top holdings in this fund are Biotechne Group, Charles River Laboratories International, Teledyne, Pool Corp, Aventor, and Novocure. And yeah, I've barely heard of any of these companies. Now, the year-to-date daily total return is negative 0.36%. The one-year daily total return is 45.74%, and the 3-year daily total return is 16.09%. Looking at the annual total return history, we can see that 2020 and 2019 performed very well. 2018 was a red year, but besides that, it's done really well, except for 2008, just like many of the other ETFs. So since VBK's beginning in 2004, they've experienced an overall growth of around 11%. And as you guys have seen, within the past 3 years, VBK has experienced really great growth. Recently, analysts have stated that they do believe VBK has 11% upside potential, with some of the fund's most promising holdings being AppHarvest, XL Fleet, and Vor Biopharma. So yeah, that's why I definitely think that this can be a great ETF to invest in. Anyways, those are my top picks for ETFs for the year 2021. The market's always changing, so I might make a more updated video later on this year, but for right now, these are my top picks. I do want to say I'm not a financial advisor, so make sure you take this video as entertainment purposes only. And before you invest in anything, make sure to do your own due diligence. Oh, and if you guys want to check out my free 1-hour investing course, I'll link that in the description below. And of course, if you want to get your 2 free stocks from WeBull or 1 free stock from Robinhood, those links will be down below as well. If you guys like the video, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. Thank you so much for your time. Happy investing, and I'll see you in the next video. Peace.